Welcome to the Daily Insights That Matter. Now, despite pandemic-related uncertainties, India has remained a favorable destination for the foreign investment. As we know, FDI plays a significant role in India's future economic development. However, in the period between April to September 2022, the FDI flows dipped. Let's discuss this today. During the first half of the current fiscal year, the overall foreign direct investment or the FDI inflows, which comprises equity inflows, reinvested earnings and other capital, decreased to $39 billion as opposed to $42.86 billion at the same time in the last fiscal year. Singapore became the leading investor in the first half of current fiscal with $10 billion in FDI. Mauritius, UAE, USA, Netherlands and Japan came after it. Now, India requires FDI because it is a crucial catalyst for economic progress. Currently, global uncertainties have dampened the appetite for investments due to uncertainties around a global recession. However, we expect that India will continue to see a rise in the foreign investments over the next 5 years. This is expected to be driven by the core sectors and the policies. Steps taken by the government towards lowering of the corporate tax rates, streamlining labor codes and introducing reforms for the ease of doing business, the massive capex spending and the initiatives such as Make in India and the Atmanirbhar Bharat have been very important for attracting foreign investments into the country. Now, the direct and indirect tax collections are expected to exceed the budget estimates in the current year on the back of higher income tax collections, customs duties and GST collections. The tax collections target for the current fiscal year as per the budgetary estimates was pegged at 27.5 lakh crores, with direct tax collections targeted to be at around 14.2 lakh crores and the indirect tax collections targeted to be at around 13.3 lakh crores. However, the total tax collections is expected to be at the range of about 31.5 lakh crores. Direct tax collections consisting of the personal and corporate taxes would be close to 17.5 lakh crores in the current fiscal year, and the collections from indirect taxes like customs, excise duty, GST collections would be close to about 14 lakh crores. Additionally, the growth in tax revenues will continue to be higher than the GDP growth, helped by the formalization of the economy and better compliance. Now, with inflation running between the 6 and 7% mark, it is imperative that the tax collections show healthy growth above the inflation rate. The strong economic growth and better reporting framework have been supporting the robust tax collections. Tax collections have been a bright spot for the policymakers, with both direct and indirect tax collections showing strong growth. Even though there was a reduction in the customs and excise duties during the fiscal, the government expects the final collection to be very close to the target set in the budget. Now, higher tax collection is a fundamental for any country, as it will help the government finance investments in infrastructure, which will have a multiplier effect on the overall economy. It will also provide a cushion to meet the fiscal deficit target on the back of higher subsidies and expenditures. So what does all of this news mean for you? Even if FDI inflows have dipped, we believe it is a temporary phenomenon due to the global macro uncertainties. We anticipate that over the next 5 years, foreign investment will increase in India, driven by policies and initiatives. This will therefore have an indirect positive impact on you. The higher tax collections will aid in the country's economic growth while also helping keep the fiscal deficit under check. This will therefore have an indirect positive impact on you again. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.